Hello, I'm Carl Warren, and I'd like to discuss with you today the new revenue recognition standard, which was issued by the Financial Accounting Standards Board in May of 2014. This new standard deals with businesses of all types, and I'd like to discuss the impact upon teaching introductory accounting. First of all, the standard was issued in 2014, May of 2014, and is effective for accounting periods ending in 2016 and 2017. However, what we need to understand is that's when most of your students will be entering the business world. So it's important for your students to understand the impact of this new financial accounting standard as they continue their education and enter the business world. In addition to that, many of our intermediate textbooks have been updated to the new revenue recognition standard, so it's important that we be consistent between how we teach introductory accounting and what the students will find when they reach intermediate accounting. That is, we want to make sure that it's the same coverage and it's up to date. It would not be good if, in fact, an introductory course taught the old method of accounting, and then the students entered in intermediate accounting and had to unlearn what they learned in introductory accounting. So that's why it's important to teach the new standard to our students. Now, the impact on introductory accounting, first of all, in the accounting cycle chapters, introductory chapters of financial accounting, it doesn't have really much impact. We have to tweak the accounting definition slightly because the new standard uses a different kind of framework for recognizing revenue. Specifically, for accountants, they use the asset liability kind of an approach to measurement of revenue. But it just required a small tweak in the definition of our definitions in chapters 1 through 4. The real impact is in when we cover merchandising businesses. Specifically, it impacts how we cover and how we teach sales discounts and sales returns allowances. Now, in addition to that, this new standard has a 5-step revenue recognition process. We've placed that into an appendix at the end of our text. In introductory accounting, the transactions we present automatically meet the criteria for the 5-step process. However, you may want to make your students aware of this 5-step process and how it might affect more complex transactions that they might encounter in the business world. The 5-step process really deals with products that are bundled together, where you basically have to divide up the revenue between two products. For example, if you upgrade your cell phone, you typically will also have to sign a 2-year cell phone service contract. Well, what's really happening there is the revenue that's being received by the company is really with respect to two products, the cell phone itself and the service contract. And so this new standard requires you to divide up that revenue as you account for it between these two products. That is dealt with in an appendix which you may or may not want to cover in your introductory accounting class. Now, let's look at the impact on sales discounts and sales returns and allowances. Here we have the old presentation method, which appeared in our last edition, 25E. And you can see here that in this old method, if you have a sale for $18,000 that you're going with a 2% discount, that you record the account receivable at the gross amount of $18,000, and then we record a sales discount if it's paid within the discount period of $360. Under the new approach, this changes. Specifically, the new standard requires you to recognize revenue in the amount of consideration that you expect to receive. And the implication of that is we want to record our initial receivable not at $18,000, but at the amount net of the discount, because that's the amount we typically would expect to receive. So in this case, we would record our account receivable at $17,640 net of the $360 sales discount, which is not shown under the new method. Sales is simply credited for $17,640, and then of course when we receive the cash, you simply debit and credit for $17,640. Now, those of us who've taught accounting over the years know that this is typically referred to as the gross method of accounting for sales discounts, and this method over here is typically referred to as the net method. Now, with respect to sales returns allowances, it gets much more complex. Under the old method, we simply debited sales returns allowances, credited account receivable for the amount of the return. Under the new method, as I said, it becomes much more complex. The new method under the standard requires us to recognize an adjusting entry at the end of the accounting period for any returns that we expect to receive in the future. And so in this case, we're recording customer refunds payable of $40,000 since we expect that customers, 2% of the customers, may return the merchandise. And at the same time, we have to then debit our estimated returns inventory for the amount of inventory we expect to come back from those customers. And then when the returns actually come back, we end up crediting cash because we're paying customers cash. And also then we reinstate the inventory that does come back into merchandise inventory. So this is much more complex, and it is specifically stated in the standard that this is how we should account for it. Basically, the logic again is that what we want to do is record sales in the amount, record revenue in the amount that we expect to receive. And so if we accept returns, we're actually expecting that some merchandise will be returned. And so we have to net that out when we record our sales. Now, if we go to the income statement, under the old method, we would actually show gross sales, less sales discounts, sales returns, allowances to a net method. Under the new standard, we just have sales. So sales is simply recorded at the net amount you expect to receive. And so this is going to affect our merchandise inventory discussions and teaching of merchandise inventory. Sales returns allowances are dealt with throughout that chapter in almost all textbooks, and it's commingled throughout the end of chapter material. So it's not really a case where effectively you can say, well, I don't want to cover one or the other. Basically, you have to go to the new method, and this is what we've done in our new textbook in a new edition.